Hi, folks. This is Mike Zlotnik, Big Mike. I'm joined here by Paul Kiebler. Hi, Paul.
Morning, Mike. How are you?
I'm great. How are you?
Doing great.
Yeah, Paul is a good friend, and he's a sponsor and operator on many projects. You've heard the name Pepper Pike. We've done many projects with Paul. Love working with him. Appreciate his in-depth knowledge and great execution. We'll talk about the new project here called Oak Park and Stephenson House. These are two assets in suburbs of Detroit, great suburbs, and we'll cover this in this short presentation. So we'll talk about only preferred equity units. There are also common equity units. Preferred units are also known as the Class A units, and the common equity units are known as the Class B units. The preferred units are the only available units. All common equity units have been spoken for. Common equity units get a lot of depreciation. We have a lot of demand for that, so we are not offering them. They are part of the offering, but we already have investors who have committed to participate. Preferred equity units are the units available for folks to consider, and they provide higher safety than the common equity units, as well as they have a high pref and a high distribution yield. So without further ado, let me jump into the details. Just standard disclaimer, this presentation is for informational, educational purposes only. It is not solicitation, nor are we offering any kind of advice. If you're interested in this deal, please request PPA on private placement memorandum to accredited investors only. Consult your attorney and CPA professional. So, Paul, would you be so kind as to give us a little bit about the Pepper Pike and the specific two properties, Oak Park Manor and Stephenson House?
Sure. So real quick on Pepper Pike, and I believe a lot of you have already heard this, but Pepper Pike is a company that I owned. Pepper Pike Capital Partners owns 4 companies. One is an acquisition company that goes out and sources deals like these. We've actually been trying to buy these properties for about 3 years now. They're institutionally owned by Lightstone. They've owned them for 16 years. The properties themselves are in great shape, but they haven't done much with the interiors, and that's where most of the rent generation is. So we're excited about finally being able to buy these properties from them. The other company is Pepper Pike Management. Pepper Pike Management, there's about 150 people within that company, and they're tasked with raising the rents from an average of about $1,000 up to around $1,500 once the renovations are done. So they do a lot of the heavy lifting, a lot of the marketing, a lot of the sales. I have a director of revenue, and I have an entire revenue team that's focused solely on increasing those rents to the maximum they can. The third company Pepper Pike Capital owns is Pepper Pike Construction, which actually goes and does the work. So, we buy these properties that were built, 30, 40 years ago in the great, submarkets, Oak Park, Madison Heights, areas with high household income, high household values. And then we find these older apartment communities that just need a lot of love. So we go and we, put new roofs, new windows on the inside. You were doing vinyl plank flooring, new kitchens, quartz countertops, all the good things that people want to see within the home that they're going to live in, and they're willing to pay a premium to live there. Then the fourth company is Pepper Pike Staffing. In total, between the W-2 and the 1099 employees, we control about 650 families now, and they all work with us, and there's about 85 open positions. So in total, about 650 individuals that help us do this, spread among those 4 different companies.
Thank you, Paul, for the great overview. All right, just talk a little bit about deal economics, purchase price, construction budget. This high level, go through the deal structure.
Sure. So Oak Park, we're buying for $47 million. It's majority of the units themselves are townhomes, so they're larger units with basements. In the basements, we're planning on finishing those off into family rooms and adding washers and dryers. So it's in a neighborhood of Oak Park, and right next to the school. It's got direct access onto the athletic fields. Oak Park historically has had very good athletics. Every Wednesday, there is a farmer's market next door. The community itself has seen one other renovation project like this where rents were increased about $600, and very similar property about 1.5 miles, 2 miles away. So we're very confident in our business plan with Oak Park. Again, 298 units, really great shape, all brick exteriors. The ownership currently put new windows in about 4 to 5 years ago. So the windows are in pretty good shape. The exterior is in pretty good shape. There's a couple of roofs we have to do some work on, but the main focus of Oak Park is going to be on the interiors, where we're going to upgrade those interiors, and that's what people are going to pay for. Not only are we adding washers and dryers, but putting custom home finishes throughout the unit. Stephenson House, 128 units in Madison Heights, which is an absolutely wonderful submarket. Again, we're about 3-4 blocks away from the school, great transportation, access to the freeway systems, high household income, little small one-story ranches that are in that submarket are selling between $300,000 and $400,000. So housing value is extremely high. We're paying $16 million or $125,000 per unit. Again, planning on doing some roof work there. Windows and doors are new. And then on the interior, they're mainly flat apartments. So they're, a 2-story building with one apartment on the first floor, one on the second floor, 8 per building. And, the interiors, 10% of the units have been slightly updated. The other 90 are original. It's still, in the high 90s in occupancy. We believe both properties probably have $150 to $200 worth of organic rent growth, meaning that if we just raise rents tomorrow the way they are, we can go ahead and achieve that. And we can also go ahead and do the renovation and get another $300 to $400 rent increase. So, the properties fit perfectly. Over the last, 15 years, we've done about 87 of these renovation deals. We currently own 14 deals in Detroit. These things are right down the middle of the fairway for us.
Thank you, Paul, for the overview. And on the right side is a combined balance there being bought as a package. So combined purchase price, 63 million, combined renovation budget, I guess, a little over 7 million. And total capitalization around 74 million. What's the total projected exit price in 4 years?
Yeah, so the total projected price is around $100 million. And, for us, we think that's a relatively conservative number. And, the units themselves, after they're renovated, we'll get a $500 rent increase plus. You take that $500, multiply it by 12, that's $6,000. You throw a 6% cap rate on it, you create roughly $100,000 of value at a $20,000 to $25,000 per unit cost, and that $75,000 of increased value per unit is the world that we live in.
Got you, perfect. And then what we are chatting about here is available Class A equity units, which we'll call them also preferred equity units. And then the common equity units, Class B, this is all the LP monies behind the Class A, so it provides higher safety for Class A equity units. And Capital Solution is a third-party investor in this deal as well. And then you got a great spread here on SOFR plus 231 beeps, which is a pretty light spread. So talk a little bit about the mortgage, and then also the rate cap that you are buying to make sure the insurance policy.
Yeah, so we went to Freddie, we're preferred lender or borrower from Freddie. And because of that status, we were able to negotiate a spread of 231 bips over SOFR. And then, we are going to be buying a rate cap, which will cap SOFR at somewhere between 4.5 and 5, depending on what the market is the day that we close. So, it's an interest-only loan. It's 3 years plus 2 one-year extensions. It's an agency loan, which actually will allow the ultimate buyer of these properties in a couple of years when the renovations are done to assume that loan and reset the principal if they want, or they can go to a bank or somewhere else. So we're pretty excited about the financing. Our relationship with KeyBank and Freddie was able to get us, those terms, which I think are, the best in the market right now.
Thank you, Paul. Yeah, I agree. This SOFR plus 231 is a very light spread, so that makes a lot of sense, and the rate cap is critical to help the downside protection of the deal. Okay, just again, very quickly about organic growth, your sponsoring experience. Go through the slide very quickly.
Yeah, again, we've owned 14 properties in the Southeast Michigan submarket. We've experienced anywhere from 6 to 7% organic growth, almost 8% in our submarkets here. So we're projecting a 6.6% year one pro forma rent inflation, and then it drops down to 3% thereafter, which we think is a little bit conservative, but rather be conservative and under promise and over deliver. And that's all based on, no renovation. So once we start the renovations, obviously, people will pay a premium to get a washer dryer, brand new appliances, brand new flooring. We always tell people that, this is, if you make $60,000-$70,000 a year, this is probably your one opportunity to live in a brand new home with brand new cabinets, brand new appliances, brand new flooring, brand new everything. And if you think about it, that's a pretty special thing. Not a lot of people making $60,000-$70,000 a year can, have that opportunity. So we use that in the sales pitch. The strong affordability and demographics. Again, the properties are at a 19% of income. Rent is 19% of the average household income, which in the United States averages about 33%. Across the world, it's about 40%. So we're, roughly 60% of what, the average within the country is. So we look at the property as being very affordable, not only for families, but for single professionals. So we like the affordability factor of our portfolio, and we try and target properties that have that affordability. And there's much more upside because rents can continue to increase. Again, effective rent's going to increase 65% compared to where they are to reach the 3 times income to effective rent ratio, which means that if we increase our rents 65% more than what they are today, the average resident will be paying 1/3 of their income in housing, which is national average. So again, super affordable. We're really excited about it. Median household income $72,000, which is high for Southeast Michigan, and it's a good market to be in. Our experience throughout Michigan, we currently own 2,800 apartments. After this closing, we'll have 3,200. Over the last 10 years, we've done probably 6,000 to 7,000 units within the Southeast Michigan market. We currently have a warehouse in Michigan that we stock all of our construction pieces and parts. I have a vice president of operations. I have a director of revenue in Michigan. So I've got about 120, 125 staff in Michigan already. It's a market we know well. We are well positioned to take over another couple of properties up there. And then lastly, the property's been institutionally managed over the last 16 years. Lightstone's owned it. 90% of the portfolio is in complete classic condition from the original construction. It's been roughly 95% or more occupied over the last 5 to 10 years. So, even with their, extremely old finishes, plywood cabinets, almond appliances and things like that, that stayed full at high rents. So, we're confident that there's organic rent growth as well as we'll be able to execute on our business plan of renovating and getting higher rents.
Great, thank you. So let's talk a little bit about the structure. We've talked about this in the past. In the traditional model, you have just the bank debt and then the common equity. In that traditional structure, all investors that pari passu, they get equal amount of cash flow, equal amount of distribution, equal amount of safety. There's nothing wrong with that model. We've done plenty of those deals, but also there is a better way, and we've utilized this model multiple times, including this deal where there's a preferred equity and common equity. And typically, preferred equity folks or Class A units get seniority of cash flow, they get seniority of safety, and their return of capital, but they don't get depreciation benefits. It's a trade-off. And then the folks that go into common equity, they take on more risk because they're behind the preferred equity folks as far as their cash flow and as far as their return of capital. They take on a higher risk, but they get the depreciation benefits. It's a trade-off. Some folks prefer one, some folks prefer the other. So in this particular deal, only available units are preferred equity units. All the common equity units have been spoken for. Again, let's just go over this deal high level. So 426 units spread over 2 complexes. Paul talked about that. The preferred equity units have a higher safety over the common equity, and then they're projected to cash flow from day one. So the preferred equity units receive 16% cumulative preferred return. Of this 16%, 8% is projected to be distributed annually from the start. Obviously, it's not day one, it's when the first quarter operation closes and distributions are available. But in general, it starts from year one on a quarterly basis. And also, preferred equity units receive a back-end piece of 15% of the profit share on the back end. And that 15% combined with 16% cumulative preferred return gets investors there at target of around 18%. And the EQM here is 1.8 or so. As I mentioned, distributions are quarterly. Projected hold period is 4 years. And then the total equity raised in this deal is 22.769 million. And the preferred equity units available is actually less than 5 million. We already have 1 million of units spoken for. So at this point, we're looking to raise only 4 million. It's fairly small for a deal of this size. And given the great terms of 16% pref, 8 paid current, and target IRR of 18% with the safety of these Class A preferred units, we believe it's very attractive for folks. Obviously, a request and read the PPM, consult your attorney professional, but that's the deal here. From a timing perspective, we are launching this shortly, around November 11th, and PPM should be available momentarily. And the funding deadline is pretty tight. It's before Thanksgiving. We realize that it's holiday and we don't want to push, but the seller and the lender want to close in November. They're putting us in a position where they're asking us to close late November. So we have to get all the subscriptions and all the dollars into the subscription account and fund the deal before the Thanksgiving, and then close right after Thanksgiving. All right, Paul, let's do it quickly again to the properties. There's some detailed pictures. So just I'll kind of run through the slides, talk as much as you want on each slide or little, and we'll go through just details on each of these assets.
Sure. Yeah, I spoke earlier about Oak Park, but 289 units. Majority of the units are townhomes. They majority of the units have full basements. We plan on finishing a portion, about 60% of the basement, into a family room and putting the washers and dryers down in the basements. And then first floor, open up the floor plan, and upstairs, there's 2 and 3 bedroom units adjacent to school district, which is a great school district, really strong athletics. They have farmers markets adjacent to the property. We're about a mile away from the access to the freeway system, which gets you downtown in 10 or 15 minutes. So great location, really well constructed, and the interiors are original. Seller updated the roofs and windows and doors, but the inside is original, and that's really where we make our money, by giving the prospective resident an environment that feels like a custom home.
Yeah, that's great. And let me go to the next slide. And are you going to paint these white? Or are you going to leave them a brick color?
We've been talking about it. We have an on-site interior decorator and design person, and we've gone through a bunch of it. A lot of the homes in this area, it's a more established, wealthy area. So we plan on leaving the brick. The brick's in perfect condition. There's not cracking in it. It's really in good shape. So we're going to acid wash the brick and then paint all of the or the little bit of siding that exists for trim.
Perfect. Okay, so talking a little bit about location and just the unit mix.
Again, if you see in the bottom of the slide, you can see the school district that's we're directly next to. There's also a very active shopping center right in front of us. There's some 1 bedrooms. The majority of the units are 2 bedrooms. There's a bunch of 3 bedrooms. Mainly townhomes, and again, we feel like the rents are $150 to $200 below market today, and then there's a value add opportunity for another $300 once we go in and do our work.
Great, thank you. Okay, so this is the look on the left is the old classic versus what you typically complete on the right. Just talk a little bit about that.
Yeah, and even the one on the left is one of the ones that they updated, so that's one of the better units. But most of the units have original plywood cabinetry, carpet throughout, roll vinyl flooring. Again, we're going to replace it with brand new white shaker cabinets, soft closing cabinet doors, self-closing drawers, quartz countertop, stainless appliances, glass backsplash, luxury vinyl plank flooring, which is hardwood flooring throughout the entire unit, and then a 4-tone paint scheme, which has an accent wall, light gray, white trim, and a white ceiling. So once the units are done, I'm sure there's a picture in here, they come out really pretty. We own a lot of the materials already in the warehouse, so we're ready to go.
Yeah, that's great. And just a quick commentary. You make them look like a Class A property finishes. These are Class B apartments, but you finish as a Class A, and you can attract the Class A customers, tenants that are looking for a little bit better affordability as we go into recession. So just talk a
Yeah.
little bit about that.
Yeah, so when the economy is really rolling and doing great, we direct market through mailers and visiting properties and things like that to a lower class C plus B minus type community. And we try and drag those people up that are paying $1,100-$1,200 up to our class A finished apartment where they could pay $1,500, but they get a brand new space with new appliances and they can really upgrade their lifestyle. In areas or in times when we might be going into a little bit of a slowdown, we actually go into the Class A apartments, which there's a ton of them around this community that are paying, $2,500 to $3,000 for a 2-bedroom unit. And then we go in and we say, hey, look, we have custom home finishes, which are actually, nicer than what you're living in. We have quartz countertops instead of granite and things like that. And instead of paying $2,500, you can pay $1,500. So when things are going really well, we try and drag residents up to the $1,500. And when things slow down a little bit, we try and drag the residents down from the $2,500 to the $1,500. So really depending on what the economy is, depends on where our revenue specialists are targeting, prospective residents. So, we're in the middle. We have the flexibility of either going up or down. So, it's been very successful for us both in good times and in, a little bit rougher times.
Thank you for the color. All right, so the next one is you get another view of this.
Yeah, some of the light fixtures, the washers and dryers and flooring.
Construction budget, it looks like you're going to be spending most of the money on I guess labor and interior finishes materials.
Yeah, so of the $16,000 on a full renovation unit, about $4,200 is for labor. Costs us another around $400 to install that washer dryer in the basement. Cabinets, obviously are a larger cost. We buy those factory direct from Vietnam. Appliances we're buying directly from Frigidaire now, factory direct. Washer and dryers, same thing. So we've done about, I don't know, 25,000 of these units in the last 10 years, have a pretty good handle on costs and, feel like we're, our budget's going to be great.
Rent increase assumption, talk a little bit about the rent numbers.
Yeah, so average rent today is $1,200. Again, we believe that, over the next 3 to 4 years, through organic rent growth as well as inflation, we'll get about $200. And then there's another $216 through doing all the work. So it brings rents up to $1,615. Our average rent increase over the last few years has been around $550. So that $415 rent increase we feel is conservative. And we try to be really conservative in these underwritings because, we don't know what's going to happen with the economy. And if there is a housing crisis, people will go back into the apartment market and, we should be, able to well outperform these. But we were pretty conservative, just recognizing, not sure what we're going to do in the next 2-3 years.
Yeah, it looks like it's about $415 increase. And then the bulk of the units are the 2-bedroom, 1 baths, going from, $1,233 to $1,638 over 4 years, with about half of it value add, and I guess half of it related to just market conditions that we live in a pretty high inflation.
Yeah, last year, the overall Detroit market saw about a 10% rent increase. So those rents a year ago were probably around $1,100. So they had a $133 rent increase just last year. And if that continues, even for one more year, 70%, 60% of that rent increase will happen, in 2023. So again, we feel really comfortable with our projections, and we tried to be on the conservative side. Hopefully, we'll be able to outperform these.
Sounds good. Stephenson House.
Again, Stephenson House is in Madison Heights, which is an absolutely wonderful submarket of Detroit. It's only 128 units. I wish there were more because it's a really great project. It's two-story brick buildings located adjacent to a freeway with great access. They're actually repaving the roads surrounding the community next to a school and in a neighborhood of homes that are 1,000 square foot ranches that are selling for $300,000 to $400,000. So it's almost 100% original. We're going to be doing some roof work, painting some of the siding. The windows and doors are newer. Put some landscaping in, and then go inside and do our interior renovations that we saw in the previous slide.
Yeah, so just yeah, right next to the highway, as you said. Is this a deterrent being next to the highway, or is this just convenience? You can jump on the highway as needed.
It's actually while we're speaking, they built a privacy wall. So they built a 30-foot high wall that stops all the view and the sounds coming off the freeway. You hardly hear it when you're on site, and inside the units you don't hear anything at all. So it's very, very convenient with the new privacy wall that the city has built, or the state has built. It takes away any of the deterrent, and it's super convenient. Again, Troy and the other submarkets there offer a lot of shopping, a lot of restaurants. So it's a super convenient location, again, next to the school, next to the freeway. You can get anywhere you want to go. And Royal Oak is about 2 miles away. Royal Oak has this awesome little downtown with a bunch of restaurants and shops and wineries and things like that. So location wise, Stephenson House has a really great location.
Gotcha. And the unit mix looks like mostly 1 bedroom, 1 bath, and 2 bedroom, 1 bath. So I guess it's what's a couple and single individual, or maybe a small. I guess you can't really call a small family if you have kids. You need 2 bedrooms, right? So I assume this is mostly.
No, yeah, there's about 20% of the units are have small families in them. One or two kids. 2 bedroom, 1 bath. And then, there's a lot of young professionals that live there. Again, with the location being near Royal Oak, being near Troy, being able to get downtown in, 10, 15, 20 minutes, depending on what part of downtown you're going to. It's a great location for that. There's a lot of parks, riding trails, and things like that. So locationally, it draws a lot of residents. And there's also, a pool, a lot of amenities at this community. So for a smaller 128 unit apartment community, it's unusual to have that kind of amenity package.
Yeah, I actually remember coming out to Detroit looking when I came out looking at the other properties as well, and I remember the pool. Got a nice, very nice pool. You're absolutely right. For the size of this community, this pool was pretty impressive.
As well as it backs up to the park system. So, you get the pool, and then you get probably, roughly 10 acres directly behind it with a baseball field and, green areas. So while it's, a apartment community located adjacent to the freeway, so you can get wherever you want to go pretty quick, there's a lot of green space and there's a lot of amenities. So, we're pretty excited about the place.
Very cool. Yeah, you don't spend too much here. You already covered this, but just a couple of words. The look here, I guess the layout a little different, but I guess the finish is going to be still the same as other projects.
Yeah, finishes are all the same. We bought 3 million square feet of the gray hardwood flooring last year. We bought 72,000 cabinets. So with that type of volume, we're able to get factory direct pricing. We're one of the largest importers of cabinets within this area. One of the interesting things, if you look over the 1, 4, and 3 numbers, are that wall is actually removed. We put a L-shaped kitchen with an island in there, and they open up the floor plan, gives you a really modern living experience.
Yeah, that's great. That's actually, that makes a difference. People don't necessarily need that wall. If they can have their, I guess, fridge moved and everything else repositioned, they can have a modern island-like experience.
Yeah, so when you rip all that stuff out, you can reposition where the appliances sit. So we're able to walk in and have that open concept feel that everyone wants. So we believe that generates some value.
Great. Yeah, I guess pretty similar allocation of costs. Your labor, I guess you have people who work for more or less the same per apartment, $4,200. Very similar numbers here.
Yeah, I've got 300-400 guys that work for me that we move around the country. They've been with me, 8, 10, 12 years in some cases. And they come here, they live here for a certain period of time and do the work. So we have negotiated contracts with them on a bulk basis.
That makes sense. During these inflation times, have you had to increase the pay? Just because then there's general inflation everywhere, including some salary inflation.
Yeah, it's so about excuse me, 5 years ago, we would pay $2,800 to do the same unit. Now it's up to 4,200. We still think it's affordable. We pay, general labor guys about 125 a day, you know, um, somewhat skilled guys, 150, MEP, which do the mechanical systems, between 175 and $200 a day. So we're still working on a day rate, and we do time studies within these units to determine, how many guys we need and, how many days they're going to be in there. So those day rates, we turn into a cost, and those day rates have gone up, a little bit. So like I said, 5 years ago, we were probably $2,800 on this unit. Today, we're around 4,200.
Yeah, makes sense. All right. I guess rent increases here, so from a little over 1,000 to over 1,400.
Again, we were pretty conservative with our rent increases. We, projected about a $400 rent increase. I think anyone would agree that getting another $250 a month for a completely rebuilt apartment, new floor plan, new everything, $250 seems light, but I think everyone would pay, the extra $250 to live in a brand new space. And then the $168, that represents about 16% over the next, 2 to 3 years. We believe that there's already $150 worth of organic rent growth just by raising rents. The place has been extremely highly occupied over the last, few years, and its current conditions. So between the two of them, it's roughly $400. And again, we've been averaging 550 or more. So not knowing what the economy is going to be doing, we were pretty conservative in our projections.
Thank you. I guess this is your footprint in the Detroit area. Just talk a little bit about your experience and many projects you've done.
Yeah, so currently we own 12 properties. When we go ahead and buy these additional 2 properties, we'll have 14 properties, around 3,500 units under management or ownership. Over the last 10 years, we've done 6,000 or 7,000 units within, the Detroit submarket. Back in December of last year, we sold 3 properties, Spice Street, Canton, and Farmington. Did extremely well on, all 3 of them. IRRs were, north of 50%. And, we got, $500 to $700 rent increases. So it's a market we know well. We have a good staff there already. We have a good footprint there. We have a warehouse that holds a lot of our construction materials. So, Detroit's it's a market we're very comfortable in.
Yeah, that's great. And that's a huge, I call it success factor, having this strong vertical integration. There are folks that do these projects 1,000 miles away, 2,000 miles away from their headquarters, and then they struggle finding good management and good execution. And for you, it's the reverse. This is one of your major strengths, because you have such a big footprint. You have a phenomenal ability to manage, maximize revenue, and to execute construction. So I see it as a great strength.
Yeah, no, we have 3 markets that we are targeting right now, and we've found a lot of properties in those markets that fit our, we're looking for a square peg to go in a square hole within these markets, and we've been very fortunate to find some great properties that we've been able to buy.
Yeah, Detroit is one of them. Obviously, Indianapolis is another where we have a number of investments, and then you also do St. Louis, right? What are the biggest 3 markets? Detroit, Indy, and what's the third one that you?
St. Louis right now. We're looking at Kansas City, which I think will be probably the 4th market. But we spend a lot of time and energy researching a market and making sure that there's a product in that market we can buy and that fit our model, as well as, there's a 20-point checklist where we look at, the larger macro issues within the market to make sure that, we're comfortable that, these properties are sellable in 3 to 5 years when the renovations are done. So Again, we've had a ton of success in Southeast Michigan. We've owned a lot of properties there. We've done extremely well with all of them. And these two fit, perfectly for what we do right down the middle of the fairway.
Thank you. All right, so this is like an example of many projects, historic rent growth. Just talk a little bit about this, and then we kind of running out of time, so let's just wrap up quickly.
Sure. So Canton, Crossings of Canton, we renovated that, average of a $521 increase. Retreat at Farmington Hills, we sold that in December, $466. Plymouth, we've owned for 32 months. We're about halfway through the renovations. We've got a $488 increase. Southgate, we've owned 14 months. We've got a $415 increase in the first 14 months. We're going to hold that about 3 years, so that should get around $600-700. Town and Country, we've had 10 months. We're at $472. That'll go up much higher. And then Wixom, we're at $458, and we've owned that for 10 months as well, and that'll go higher. So sort of wanted to show, what rent increases we've achieved throughout the Detroit submarket. And a lot of the properties were in the beginning of the renovation stage, and we've gotten $400 almost a $500 rent increase. But as we continue to own it, we get new generation of leases, those will continue to increase.
Great. Yeah, I guess it's a strong submarket with a strong rent growth historically. Yeah,
Detroit's been, they've had, I don't know, 30 years of continued rent growth every year, ranging from, 2.18 all the way up to 7.7%. So really stable, strong market. I guess overview of the county. Oakland County, high-end market, a lot of white collar workers. 74% of the workers are white collar. Good income growth, good household income, highly educated, larger renter class. So it fits perfectly within our business plan. Another county, Wayne County. I guess these apartments are in which county these apartments are in? Yeah, they're actually in Oakland, but they touch. So we wanted to show both of these. So we actually pull from Wayne County sometimes when we do our marketing, but Wayne County, again, great submarket, great county, large renter class. It's a lot of job growth. They're doing I think $10 billion worth of development within this county on job growth and things like that. So Wayne is where Detroit the city is, and they're doing a lot of new construction, a lot of job growth there. Makes sense. And at this point, you've done more than 81 properties. You're probably close to 90 now. Yeah, we're actually these two will be our 88th and 89th. We've done about $3 billion worth of transactional value. We've around 35,000 units. We've been in actually 9 states and 16 cities now. So we should update our slide, but we've for a company that started in 2002, we've had a lot of success, and we've been working really hard. So it's all good. Thank you, Paul. And folks, reach out to Alina or me. Just email us at invest@tempofunding.com. If you have interest, requesting PPM, and this deal will go fairly quickly. So if you have interest, please take action. Appreciate your time and attention. Looking forward to your quick response.